Well, yesterday we saw the Reserve Bank's result at the March board meeting, and as expected, there was no change in interest rates and no change in other balance sheet policy. But there was a very significant change, I believe, in the way the Reserve Bank concluded their final paragraph. So in the past, they've referred to aggregate wages need to be at a level that'll be consistent with a sustainable inflation target. And we've read that for a long time representing the wage price index, which we follow very closely on a 3-month basis. And for the last couple of years, the Reserve Bank Governor has referred to that needing to be growing at 3% plus to justify a rate hike. Now, the problem has always been that that's been a very slow-moving index. It's been weighed down by enterprise bargaining agreements that are set for 2 to 3 years, award wages agreements that go for a year. So when you see a sharp strengthening in the labour market and a lift in wage pressures, it takes some time for that wage price index to show through. And we saw that once again last week when the wage price index printed 2.3%, which is only about where we saw it pre-COVID. And yet we know, talking to customers and looking at things like job vacancies, that pressures on wages are a lot stronger. So it was very interesting yesterday when, instead of talking about aggregate wages, they talked about labour costs. So now it has to be that labour costs need to be consistent with the inflation target. And labour costs, of course, are a much broader measure. You're not tied down to that one wage price index measure. You're covering things like, what are we hearing from businesses in surveys? What are we hearing in the Reserve Bank survey? What's happening to bonuses? What's happening to turnover in the market? Because the general impression is that if someone leaves a job voluntarily, about a 10% pay rise. If they're poached, about a 20% pay rise. So all of those factors provide a much more timely measure of pressures in the labour market. Now, the reason why that's important from the perspective of our forecast that the RBA will be raising rates in August is that the next print for the wage price index we think will only equal 2.5%, a long way from that 3% the Governor is targeting. But it's been our view for some time that they would start to pivot away from just looking at that wage price index. They'd also be prepared to look at the momentum in the market. So in the last 2 prints of the wage price index, the total growth was 3%. So for all those reasons, even though the wage price index was only going to print 2.5, we thought that was still going to be consistent with that August rate hike. And of course, we were given more confidence around that when the Reserve Bank Governor, in his testimony to the House of Representatives Standing Committee on Economics, when he talked about wanting to see 2 more CPI prints. The first one will be on the 27th of April, the next one will be on the 27th of July, setting us up for that August rate hike. It's also interesting that the market that was absolutely adamant, and many published analysts were adamant that the first rate hike would be in June, that's now been scaled back. A month ago, the pricing for that was more than 100% for a June rate hike. Now it's back to less than 50%. So it's certainly moving in line with our expectations. The other thing that came out of the RBA statement yesterday was the emphasis around the uncertainty associated with the war in the Ukraine. And every central bank around the world is signalling the same degree of uncertainty. Now, when I look at the issues that central banks are facing, the big issue for me is whether they will be able to guide inflation back into the 2 to 3% band in 2023 and 2024. We know that inflation is going to be well above that band in 2022. In Australia, we're expecting it to be well above 4% and underlying inflation to be at 3.5%. But it's what happens in 23 and 24 that's going to be really important. And at the moment, markets are pretty comfortable that central banks will be able to make that adjustment without pushing interest rates into really damaging contractionary territory. So the market is still expecting that the Fed will be able to see rates at a peak of around 1.8%, which I do not see as contractionary. In the case of Australia, they're at 2.5. That's still too high. We think it'll get into 1.75. So it's really that debate about whether central banks can achieve that. So what does the war in Ukraine do in terms of that debate? Well, if we think about how inflation will come back to within that 2 to 3% band, there'll be three ways in which it'll do it. The first way will be the freeing up of the supply chains. The second way will be an unwinding of the huge lift in energy costs that we've seen at the moment. And the third way will be an absence of that wages, prices, feedback mechanism that embeds inflation in the system. Well, of course, the Ukraine developments have meant that on the supply chain front, great disruptions to shipping, and there are a couple of major exports that Russia has, palladium and aluminium, that are important to the chain. But Russia is only 25% larger than Australia, even though it's 140 million people, and of course Ukraine is 10% the size of the Australian economy. Russia's role in that supply chain process, I think, is fairly limited. So although the war will absolutely extend the time at which we start to see genuine correction in those supply chain pressures, I don't see it as changing the overall profile that central banks can get that inflation back down in 2023, 2024. Of course, the other big issue I mentioned before is energy prices. And there, of course, Russia is very, very important. They're about 8 to 9% of total of world production of oil, about 8 to 9 million barrels a day. Global output about 100 million barrels a day. They're 30% of the demand for gas in Europe. So these are big numbers. Now, one of the other big issues will be whether Russia will be able to maintain the flow of its energy exports despite the sanctions and the SWIFT restrictions that are going on the Russian entities, including the Russian financial system. Now, the White House has made it pretty clear they want those energy flows to continue, but of course there's significant political pressure. Canada has already decided to stop its imports of Russian oil, but of course Canada's not a major player. The Republicans are pressuring Biden to do something about Russian energy. So that sits there as one of the big question marks. We've been fairly relaxed about the fact that the commitment is so strong in the US and Europe to maintain those flows that a real spike in energy prices that would result from those flows being stopped is unlikely to happen. But it's something that we need to watch very closely. But finally, if we do see a higher and longer energy prices, then I believe that will certainly mean that the recovery back in inflation terms to those targets will take longer. But I think that we're still in shape to achieve that. And that will be the really big issue in terms of how markets will react. And finally, the most important point is whether we see this lift in inflation that we've got at the moment starting to push into a permanent lift in wages. So not just a one-off lift in wages that we've seen as a result of the post-COVID huge lift in demand and some wage shortages, but an ongoing permanent lift in wages. So inflationary expectations lift, and workers expect to get a wage, and businesses expect to raise prices. And so we see what we saw in the 70s, where the inflation really took hold. And that was what you would call the stagflation, when you had ongoing strong inflationary pressures linked between wages and inflation. I don't think that's going to happen. I think central banks are well and truly alert to that risk. I think the Fed will start raising rates in March. I think they'll be looking at those overall risks, and we'll see those rate hikes in the US in March, May, June, September, December, and reaching that point near the middle of next year when they can feel that they've won the battle. But if you take your eye off that big problem associated with the feedback from wages to prices, then you run that risk of losing control of the real inflation battle. So that's why I think central banks will remain targeted on that particular issue, whilst it may well be that the disruptions from supply chains and energy prices take longer to resolve. But we think that will eventually happen as economics works in that direction. The problem is if we let wages get away and that wage price spiral really start to build. And when we think about markets, think about 1970, when the Australian share market sold off as a result of the first big oil crisis. It took nearly 10 years for the share market to get back to its level in 1970, the lost decade of the 70s. But it wasn't because of geopolitical crises, it was because wages and prices got embedded in the system. I can talk about many examples where we've seen geopolitical crises emerge, but because it doesn't embed wage price inflation into the system, markets tend to recover. Central banks can cut rates when inflation has started to fall. But if we get that wage price spiral in the system, then it's a much more difficult problem. Central banks understand that, and that's why at the moment, while the Russian crisis has higher uncertainty associated with it, central banks will keep their eye on the ball, which is to contain that wage price inflation risk down the track. Thank you.